Welcome to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have John Rubino with me. Once again, John's been a frequent guest over the years on Turning Hard Times to Good Times. You will know him from his past websites, the Dollar Collapse website, which he founded and has since sold off. He's now an active writer on Substack. He is also an author of several books. The Coming Collapse of the Dollar, probably the most well-known one, which he co-authored with James Turk. But another one that caught my eye here is Main Street, Not Wall Street. It was an interesting title, and I don't believe I've ever read that book, but it seems like apropos for the views that the Treasury Secretary is stating, the views and the aims of the Trump administration, maybe to give Main Street a break now after Wall Street has had a party for so many decades. So I want to ask John about that. He is a frequent, really written professionally for many years. Also traded on Wall Street, was an analyst on Wall Street. So I'm really pleased to welcome John here once again. Thanks for joining me, John.
Hey, Jay, great to talk to you again.
Always good, John, always good. You know, I'd like to start out by asking you the same question that Adam Taggart likes to ask his guests frequently, and that is, what is your current assessment of the global economy and markets, John?
Well, I think we've built so many problems into the system over the last 30 or 40 years that there's no easy fix. So my assessment is that we're headed for a massive currency crisis, and we've already entered kind of the death spiral part of that, where the world's governments have borrowed so much money that the interest carry cost on that debt is now becoming debilitating. So countries really have no choice but to try to inflate their way out of it. Otherwise, the debt costs, the interest costs on their debt will eat them alive. So we're there, and there's nothing we can do about that.
Yeah.
The Trump administration is doing a lot of interesting stuff that might have positive consequences down the road, like the tariff thing is chaotic, but if it leads to a lot of companies around the world building factories here in the US, that's a good thing for us long term. And getting us out of the Ukraine war is an extremely good thing. So there is positive stuff happening. But the currency crisis side of the future is kind of baked into the cake. Yeah. And as gold bugs, that's kind of what we focus on, right? Because if the governments of the world have to inflate away their currencies to make their debts manageable, then that's an environment that's historically great for gold and silver. And so that's the investment thesis. You want to move out of financial assets and into hard assets like gold and silver and related mining stocks, et cetera, et cetera. And so the further down the road to a currency crisis that we travel, the clearer that investment thesis becomes. And we're seeing it happen out there in the real world now with, gold doing what it's doing and the mining stocks starting to catch up. So the stuff you and I've talked about is finally starting to come to pass.
That is for sure. It's taken longer, I think, than either you or I or a lot of other people thought it would take. But it just seems, as you say, it's baked in the cake. The math doesn't work anymore with debt going parabolic and interest rates. A shortage of savings to fund the U.S. deficit is just enormous. And where is all that money going to come from? How can interest rates go down when they need to, because our debt is so high? Let's talk a little bit about, maybe you could talk a little bit about the book, Main Street, Not Wall Street. And I just had to ask you about this, John, because Treasury Secretary Bassett has been talking about repeatedly, I heard him say it more than once, Wall Street's had a party, you've had a pretty good time, and you're going to continue to do okay. But now it's time for Main Street to catch a break. What was your thesis in Main Street, Not Wall Street, written, I think, in the 2000s sometimes? I don't remember when it was written.
In the early 2000s. Yeah, the thesis was a little bit different than what we've got going on today. It was a book about using local knowledge to invest in local companies, because that's, an advantage that you have over Wall Street is that you kind of know what's going on around you. You can, if you choose to become aware of them, get to know a lot of local companies. And the ones that that are really succeeding become good investments, and you know about it before Goldman Sachs or somebody like that does. So that's still an interesting thesis in the sense that you should always be looking for your advantage.
Mm-hmm.
You know, the thing that you understand better than the investment community, and that's the best place for you to invest. But what's happening now is that over the past 20 or 30 years with globalization, corporations have been able to basically break the back of unions in the US and keep salaries very low so that the big American corporations captured a bigger and bigger part of corporate profit growth during that time. You know, wages basically were stagnant, but corporate profits went through the roof, and the stock market benefited from corporate profits going up. In other words, stocks became more valuable as the underlying companies made more and more money and kept that money because they didn't have to pay it to their workers. Well, we've reached the point where that's no longer politically tenable anymore, right?
Yeah.
People have caught on. They're voting for populists like Donald Trump, who promised to get back for workers what was stolen from them. So what's happening now in the US in response to that is that wages are having to go up. Companies are having to pay more and more to their workers because unions are regaining power now. So most industries that have any unions at all in the US are seeing wages go way up because unions are able to collectively bargain and threaten to strike and win those strikes and get big pay increases. You know, it's happening in aerospace and it's happening in manufacturing and several other places. Mm-hmm. And what that means is that companies get to keep less of their profit increases going forward. And that's great for workers, but it does bring a couple of problems for stock investors. Mm-hmm. And one is that companies are going to report going forward slower profit growth, mm-hmm. which means their equities aren't as exciting anymore. You know, and you're not betting on infinite growth at a double-digit rate anymore. You're betting on modest growth, if any growth at all, in earnings per share. That makes stocks less interesting. And the other thing about wage growth is that the Fed considers that to be inflation. You know, wage inflation is a real deal for the Fed, whereas the Fed doesn't count assets going up. You know, stocks and bonds and real estate going up are just positive growth in the economy as far as the Fed is concerned. So they don't care about that kind of inflation. But when workers make more money, mm-hmm. they get scared. Mm-hmm. And so to the extent that wage inflation becomes a real thing, the Fed will probably be compelled to raise interest rates more than they would have otherwise. Mm-hmm. And that also makes stocks less valuable because when interest rates go up, they, bond yields then start to exceed corporate dividend yields by a bigger and bigger margin. And for a lot of people, it just, it makes it kind of a no-brainer. You buy the bond yielding 5% rather than the stock yielding 1 or 2%. So again, equities become less interesting and the stock market goes down. Yeah. So that's kind of what we're looking at in the intermediate term future, where stocks just aren't that interesting from the standpoint of earnings growth or dividend yields, and maybe that makes the equity markets go down. Now, there at the same time, there are people like Martin Armstrong who come at this from a different angle and say, okay, the U.S. has its problems, but the rest of the world is vastly in much worse shape than the U.S. is. So we're going to see a lot of capital flowing into the U.S. Mm-hmm. regardless of corporate earnings or real estate prices or whatever, because the rest of the world is so terrifying that if you're a millionaire in Brazil or Russia or China, and now Europe, you're going to consider moving your money out of your home country and into Miami condos or mm-hmm. or farmland or U.S. equities. So we've got these two cross currents right now, two countervailing forces that make the stock market a very interesting place in ways that we've never really seen in our lifetimes. And, I don't know how it plays out necessarily, but I think those are the forces that we should be watching as we decide what to buy.
Right. And I would think also to the extent that Trump's successful in getting industries wealth creating industries to move back to the U.S., that also would put some pressure on wage, that would increase wages as well. If the demand for workers, especially in the sort of higher value added industries, I'm thinking mining, I'm thinking manufacturing and some of those things. If to the extent those industries come back to the US, then and we maybe don't have that many workers that are capable of, right now. So there could be a shortage of workers at the
Well,
same,
yeah,
yeah, and more pressure on wages, I would think.
yeah.
Of
These
course,
big. Oh, go ahead, Jay.
yeah,
Sorry.
I was just going to say the solution to high prices is high prices. So high wages will beget and probably get people off their couches and start doing stuff again. That there's a lot of people that aren't working, John, yet still, just for one reason or another. There's the unemployment rate, and then there's a lot of people that are simply not in the workforce and aren't counted. We'll see where it goes, but yeah. So, and I also think that with regard to the high tech, those companies that were selling at high multiples that were enjoying this rapid growth rate in revenues and profits and so forth, they're coming under a lot of pressure already, aren't they?
Well, yeah. A lot of the big companies out there are damaged by the tariff and trade war thing that we've got going on because, if you're a chip maker, you're probably dealing with a 10 country supply chain where something is made here or it's mined here, then it's processed here, and then it's turned into basic components here and they're assembled here, and then they go to the final assembly and then they're shipped to other countries, and you can't have a trade war in that kind of environment without it really damaging the profitability of a lot of these big chip makers,
Right.
especially. And also what you said before about companies coming to the US and that driving wages up, that's a very big deal too, because all the new chip plants and auto plants that are in theory coming here are going to have to pay way up to get the kind of talent that they need to compete with the same factory in China or someplace.
Yeah.
So yeah, wages are going to go way up, and corporate profits will go down as part of that process.
I could see the Trump administration opening the doors to talented people around the world to come in, as opposed to lower end wage earners that we've experienced over the last number of years. But we'll see where it goes. So you wrote an article, how do we play this bear market? I assume from that you believe we are starting a bear market now, John? We're entering a bear market now?
Well, a big part of it, or some of it, has already happened. We've had incredible volatility lately, and it's ended up on the downside, where the NASDAQ and the Dow and the S&P 500 have all lost quite a bit of value. But stocks remain wildly overvalued. And if interest rates are going to stay at the current level, then stocks have to go back down some from here. And, we probably got a recession coming at the same time because consumers are basically tapped out. We've got more and more people who are putting day-to-day life on credit cards, and then, which means they're carrying loan balances that are charging them 25% a year, and that's a recipe for a bankruptcy there. And so across the board in the U.S., we've got weaker consumer spending probably coming, and that's going to give us a probable recession in the coming year if we're not already in one. Usually recessions start before we realize we're in them. And that usually leads to an equities bear market too. So all of that stuff is just kind of coming. It's not something that can be fixed in the short run because all the damage is already done. Consumers are already tapped out, and companies are already wildly overvalued. Their stocks are wildly overvalued, and corporate debt is very high, and government debt is very high, and the interest costs, blah blah blah. All of that stuff points to a recession. And that's probably the story of the second half of this year and the first half of next year. So yeah, that's and that normally leads to an equities bear market. So all of that stuff, just in the normal course of things, should be happening now. And the question is, what happens next? In other words, does a recession and equities bear market metastasize into something much more serious because we're so over indebted? And I think there's a very good chance of that. I think governments around the world are going to be panic cutting interest rates at some point in the next 6 to 12 months.
Right.
And the question then becomes, if you cut short-term interest rates, will long-term interest rates follow, or will the bond markets panic in the face of what they perceive to be excessive ease? Because, the Fed started cutting interest rates in the US in September.
Mm-hmm.
And since that time, long-term interest rates in the US have gone up.
Right.
And that's a sign that the bond markets no longer trust the world's central banks to maintain their currencies at a stable value. And if that's what's going to happen, then the Fed can go ahead and try to cut interest rates, but it'll actually make long-term interest rates, which are much more important, go up.
Yeah.
And that'll crush the stock market, which was the thing the Fed was trying to fix in the first place.
Right.
So, there's a decent chance that this is basically the end of the fiat currency experiment, when easy money no longer fixes over abundance of debt out there. And so, and that's something you and I've been talking about forever, Jay.
Right, for sure.
It should have, like you said, it should have happened sooner.
Yeah.
And it could be that we've all given up waiting for it to happen because it's been such a long time. And that's when it starts to happen. So I think things get much more interesting than they are right now going forward. And things are pretty interesting right now. So that's saying quite a bit.
Yeah, interesting is one way of putting it, John. I know that, Jim Rogers on my show here a few years back said, the big mistake was not allowing 2008 financial crisis to run its course. Instead, we printed more money, dug ourselves deeper into debt, and now the math doesn't work anymore, as you point out. Maybe it's not just a recession, but something worse, like a depression, something that is going to require some sort of a monetary reset. And I think in a way, we're sort of seeing it happen as gold is continuing to rise. And a lot of the countries, especially the BRICS, those that are not friendly to the NATO nations, have been, just as you know, better than anyone, just building tremendous amounts of gold for financial assets, as their financial assets and central bank assets. And the people in many countries have been, not so much the West, because the propaganda has really been against gold, pro-dollar against gold. But, Pinocchio's nose gets so long eventually that they can no longer hide it. So you raised a question, or you talked about cheaper oil. Oil prices have gone down. They're up a little bit this week, but cheaper oil. But also, if we go into a strong recession, John, that could also tamper, maybe keep inflation down somewhat. And then perhaps, I'm hoping perhaps, keep interest rates from rising too dramatically. But on the other hand, though, we still have, as you point out, this enormous debt that has to be financed, and there's just not enough people. Other countries anymore aren't wanting to buy dollars and buy our treasuries as they once did. So what do you think? We could be in for some sort of a monetary reset here?
Yeah, at some point it has to happen. And what's going on with gold is an interesting part of it, because basically gold is the only thing going up right now. Tech stocks are down, retail stocks are down, banks are down, and gold is having one of the better bull markets in its last 100 years.
Yeah.
This is interesting because it implies that the world's central banks, at least, have made a decision, and they want to keep accumulating gold without being price sensitive about it. Apparently, especially the BRICS countries, their central banks have been ordered by their governments to accumulate X amount of gold to allow them to back their currencies with gold during the next currency crisis. And so the central banks are just out there buying as the price goes up without really, being sensitive to it. They're not pulling back, they're not selling anything as the price of gold goes up. And that's allowed gold to outperform everything else. Now, the question is that something that runs its course at some point? Do these guys, the other central banks, just accumulate enough gold and stop? And then does gold go back down? Or is there no real end to this until there's a currency crisis leading to a currency reset? And I kind of think it's that, because as long as you're heading into a major currency crisis in which the big fiat currencies of the world start to fall in a disorderly way, there's no reason to stop buying gold, right? If you're trying to back your currency, if you're India or somebody or Russia or China, and you want to back your currency, there's no reason to stop buying gold to prop up your own currency when the big currencies are still heading into their crisis, because gold is going to become more and more valuable in dollar terms and in euro terms and yen terms. So there's no reason for the People's Bank of China to stop accumulating gold. So I think it's possible that, there's always possible that there's going to be a correction in any kind of a bull market. They always happen. But I think the intermediate term with gold is probably still favorable at this level, just because the world's central banks aren't traders. They're acting in a way to protect themselves from this big crisis that's out there. And until the crisis happens, there's no real reason for them to stop. So, yeah, so I think that's great for gold, and it's great for the mining stocks that make their money from gold. And the interesting thing about the mining stocks is that they didn't respond to rising gold for the longest time. And they're just starting to now. You're seeing the big miners see a lot of inflow of capital, and that's causing their prices to go up. So in my Substack portfolio that I publish for subscribers, there's a long list of large gold miners and related ETFs that are up, 50% or so in the last year.
Right.
And again, if gold keeps going up, there's no reason for the miners to not continue to report excellent numbers, because they're basically selling something that goes up, which gives them higher revenue, which gives them wider profit margins and makes their stocks more interesting. So I think your audience ought to start paying attention to first quarter earnings for the gold miners.
Right.
Because they're going to look really good, I think, because gold is way up, both sequentially and year over year for these guys, which means they're making more per ounce of gold that they sell. And their profit margins are very wide, and their cash flow should be rising. This first quarter numbers ought to see sequential growth in free cash flow, which is a really big deal for a mining stock. And if not enough people are paying attention to this, it's going to come as a pleasant surprise to them when they see these mining numbers out there. And it's going to lead generalist investors to start buying these stocks. So I think that's a big part of the dynamic for the mining stocks, is that generalist money hasn't really started to come in yet.
Right.
But the next set of earnings that come out are going to be sequentially so good and year over year so good that it's going to attract a lot of people who are looking at momentum, earnings momentum, stock price momentum, things like that. And there's just so much potential investable cash out there that even a little bit of it flowing into the gold miners, and you'll see that bull market that should have happened already with gold at 3,000. We'll see that finally happen in the year ahead.
Right. Well, I think, and you pointed out in one of your Substack missives here, I guess this one was dated the 10th of April. We've got Newmont reporting on the 23rd of April, Agnico Eagle on the 25th, and then Franco-Nevada on May the 7th. So people should better be watching, keeping their eyes, because if the market starts to catch on, and I think to a great extent, John, Americans are still asleep. Not the big hedge fund guys, not the big money guys. I think they're buying gold and gold shares probably to a great extent, maybe. I don't know. But most of the people I talk to that aren't into gold, they have no appreciation yet for gold. They hardly even know that it's at $3,300.
Well, I have a friend here who has a financial advisor who's been great for him. She's had him in just large cap growth stocks, and so he's made money over the past couple of decades with her. And he asked her for a gold stock. And she said, well, I don't really specialize in anything like that. Maybe you should buy some on your own, just set up your own account. And then he badgered her a little bit. And so she gave him Barrick, which is the worst performing big gold miner out there. And it's up 15% while these other guys are up 50 or 100%. So the average financial advisor is not into this stuff yet. I think the stat is not really changed yet, but the average portfolio out there has 1% exposure to gold.
Yeah.
And that's nothing. You know, you could have 5 or 10% and justify it, since gold is the only thing that's up right now.
Yeah.
And if something like that were to happen, it would just light a fire under these equities. You know, they would see more money flowing in than ever.
Yeah. Well, I don't, I certainly, I mean, I saw John, I forget who tweeted it, a CF, a professional on Twitter, on X, talked about, I think he said that the GDX composite index, that those companies are selling at something like a 20% discount to free cash flow right now. You know, so we're still selling at a deep discount. And that's going to change when Americans wake up, I think. And it probably will take more pain in the equity markets. You know, I'm sure a lot of people are thinking, well, we've had our 20% correction or whatever. I don't know what it is right now, but a pretty decent correction. It's not going to get much worse than that, John, because we know that the Federal Reserve is going to come to the rescue. And they're not thinking about this parabolic move in gold, which is really saying that we have a parabolic decline in the dollar, essentially. That's the way I read it.
Well,
Yeah.
For the professional lifetimes of most investors right now,
Yeah.
there's always been a Fed put. In other
Yeah.
words, if the market started to crack, the Fed would step in with easy money. And so it's always been a good idea to buy the dip.
Yeah.
And if this is the time when it's finally not, then, you know, they're not going to stop. They're going to buy the dips because that's what they've always done. And that supports the market for a while.
Mm-hmm.
So we should expect that. I mean, we should expect the NASDAQ to go down by 8% or whatever, 15%, and then a lot of money pour back in and push it back up and so on. But each dip is going to get more brutal and disillusion more people. And then at some point in that process, then they switch gears and they say, well, sell the rip. You know, whenever it recovers a little bit, try to get your profits out of it. And that's when you get a serious bear market.
Yeah.
So that is
capitulation,
coming, probably. Yeah. Well, capitulation is at the very bottom when you sell
everybody gives up
everything at any price.
Yeah. I'm going to jump over the cliff. There's no way to go on anymore. This is hopeless.
Well, and see
that's when you want to have some capital to buy. Now, I don't know what currency we're going to buy. John, if we have a reset, it's hard to know how this plays out, right?
Well, your currency at that point should be gold and silver. And then you switch it, or your money should be gold and silver. Then you switch into whatever currency you want to use as a medium of exchange. Hopefully by then we've gone back to a gold standard or done some other thing that takes the power to create money out of thin air, out of the hands of governments. And there will be a currency that we can switch our gold and silver into that we can use to buy stuff.
Right. It would sure be nice if we had a currency that was backed by real money. That is not just a currency, but gold, which is...
Well, I think that's the only solution at some point, because the concept of fiat currency, in other words, a currency that is just whatever the government says it is, not backed by anything, that becomes so discredited that they can't just lop off some zeros of the current currency and then like Latin America frequently does, where they'll just bring out the new peso. You know, if we try to bring out the new dollar, but it's still a fiat currency, I think people will be smart enough to know not to be fooled. So we'll see.
John, on April 8th, you wrote an article, Watch the Gold Silver Ratio. Why is that important?
Well, gold and silver trade in a range relative to each other over time. And the usual range is, say it takes 40 ounces of silver to buy an ounce of gold, up to 80 ounces of silver. That's a normal range. And when that range rises, in other words, when silver becomes more and more undervalued relative to gold, and the gold to silver ratio goes up, that is a buy signal for silver beyond a certain point. And 90, in other words, 90 ounces of silver equaling 1 ounce of gold, is historically a pretty strong buy signal. Well, just lately it went up to 100. In other words, it takes 100 ounces of silver to buy an ounce of gold.
Right.
And that is a screaming buy signal for silver historically. Most times when that happens in the past, silver outperforms gold while they're both rising.
Right.
So if history is still a good guide to the future, then silver ought to be a really compelling buy right now, and it ought to outperform gold by 2 or 3 times going forward. In other words, gold doubles from here, silver goes up 5 times, which puts it above $100 an ounce, which would be a really nice environment for the world stackers, right?
Yeah. Yeah, I mean, the problem is the silver and the silver shares haven't performed that well. We're starting to see some of the silver shares that I own do better. One of them is in Mexico, and I noticed that one of them, Rubino, Silver and Gold, is a smaller company doing quite well, raising their production, and the share price is responding pretty nicely. But Mexico maybe isn't the best environment. I know I talked to Quentin Henning, who's also with me this week, about Mexico, and Crescat Capital isn't very keen on Mexico. They're not interested politically. They think it's not a good place to be right now. And you wrote an article, Bad News for Mexican Miners, Good News for Physical Silver. I take it you're suggesting that maybe there'll be less production of silver coming out of Mexico, even though Mexico is known for its silver production.
Yeah, Mexico is the biggest silver producer in the world.
Right.
So trouble there is trouble for the whole silver market. And you know, a lot of the biggest silver mining companies operate in Mexico.
Right.
So if Mexico is going to change the terms of the deal with miners, in other words, go to them and say, look, we want a bigger cut of the action, or we want to just nationalize your property and run it ourselves, that's really bad for those stocks.
Sure.
And if you're invested in those stocks, you risk losing everything. But if Mexico does stuff like that, then production of silver is going to plunge in the country.
Yeah.
And that's the biggest producer. So that's going to cause silver supplies to be even tighter than they are now, which will make the price of physical silver go up. So, you know, mining has been a very tough business and getting tougher for a long time, which leads some people to think that just owning the physical is the way to go, stored in a safe place, you know, and so don't worry about the vagaries of the mining business or anything. Just own the physical silver and physical gold, and you get most of the value of a precious metals bull market by doing it that way, without a lot of the risk in mining. And the whole Mexico thing makes me feel like that might be true, you know, that location, which has always been a very important thing for mining, is now becoming one big risk, because there are very few countries that are just, you know, purely good jurisdictions anymore. Because Mexico used to be a pretty good jurisdiction. Right. Canada used to be an excellent jurisdiction, and now we really don't know how Canada is going to behave. Yeah. So maybe we're just down to Nevada as the only good jurisdiction left. For
Alaska, miners. Nevada, maybe some of your Western countries, Idaho, where you used to be on, and some of the things going on there too. For sure. Well, you know, what you're saying, very few jurisdictions. Ghana, which was probably the best jurisdiction, one of the best in Africa, one of the safest. I think just this last week is saying they want foreigners out by the end of, or by May or sometime like that, end of May.
Yeah.
So, you know, I think, we're going to have to be more careful about the countries that we invest in through these mining companies. So,
and we kind of want to skew our capital towards physical relative to mining now too. Right. Although, you know, the miners that succeed are going to be 10 baggers. Yeah. So I think we just have to be very careful about which ones we own, you know, where they are, how competent management is, and how big is their resource. Because you want, Rick Rule has a saying that I think is very wise. And he says, a small mine and a big mine are subject to the same risks.
Right.
But the big mine will make you way more money if they succeed, you know? So look for, look for juniors and for explorers that have potential tier 1 assets.
Exactly. Yeah. Right. And even those aren't easy, John. You and I have followed some companies that have had difficult times, but some of them are rising to the top. The cream rises to the top, as they say. And you know, a Snowline Gold, for example, is one. I think I was talking to Quentin Henning this past week, and he says, well, I mean, what's the upside from here? Because it is about it's about $1 billion market cap now, I think. And you know, what's the upside from here? Well, maybe it could be quite big still. Uh, but the exploration risk is gone. So, but he says you almost have to have it in your portfolio because it's one of those tier ones that are going to get bought out at some point.
Yeah, with Snowline, we're just kind of waiting around for them to be bought out, huh? Because all the
Right.
big questions have been answered.
Well,
Yeah.
that is true, but Snowline also is a lot of exploration potential yet still there. So, but I think there's like some of the others that are more advanced. They're doing their engineering now. They're starting to do some of those things that are at the bottom of the Lassonde curve after the discovery. You have to wait a few years sometimes before you successful production or a buyout, hopefully. But I think there's a lot of good opportunities yet. John, I think you pretty much really favor the royalty companies and streaming companies, don't you? And the risks on those are somewhat lower, I think.
Well, the royalty companies, basically what they do is they go around and finance emerging mines,
Right.
and they take a cut of the mine's produce once it becomes a
Off the
producing
top.
mine. Yeah.
Yeah.
And so they might have several hundred of these deals, which makes them very well diversified
Yeah.
geographically and in terms of different metals and different miners. And that protects them from the mine specific risk that a lot of other miners suffer from. Look what happened with, actually, the Cobre Panama mine is a really good example of this because Franco-Nevada, which is a big royalty company, had a pretty big investment in the Cobre Panama mine, and the Panamanian government just shut it down, and that hurt Franco-Nevada for a while.
Yeah.
But in the meantime, all its other deals are happening, and it's making money, and so it's up at a higher price than it was when the Cobre Panama mine shut down. But the company that owned the Cobre Panama mine was devastated. It lost its biggest asset.
Yeah.
So Franco-Nevada recovered very quickly, and the actual owner of that mine did not recover very quickly. Yeah, and so that's why you should own a lot of good quality royalty companies because they're in the gold and silver mining sector. They have the leverage. A lot of these companies now, their gross margin now on an ounce of gold sold is like $200 or $2,500.
Yeah.
So gold is at 3,000. They make $2,500 for every ounce of gold that they sell. So that's the kind of profit margin where you can't help but make serious money.
Yeah. Yeah. And the royalty companies don't have to be concerned with ongoing capital infusion for, when things wear out, they have to replace them. And the royalty companies get something off the top. They're not worried about the bottom line. As long as the company's producing the gold or silver, they're doing fine. And the prices go up, they're doing even better. So, yeah, I think it's the best model for investors, the least risky. And they tend to sell at higher multiples than the most mining companies as well, I think.
And there's an M&A boom that's going to happen there pretty soon because the smaller royalty companies are cheaper. Yeah. So somebody like Wheaton Precious Metals, it trades at, I think it's 2 times their net asset value, can buy a smaller royalty company that's trading at 1 time and a NAV. And then instantly all those assets are revalued once they become part of Wheaton Precious Metals. They become twice as valuable.
Yeah.
So
we've seen that happen.
Yeah.
Yeah.
So a lot of the little royalty companies are going to get bought out in the year ahead, I think.
Yeah. Well, so bottom line, there's a lot of upside. I think you see a lot of upside potential, gold and silver, especially silver, probably. Maybe not the miners as much as just own the silver itself.
Well, no, I think the miners will do really well because they're going to be reporting such great numbers.
Great profits, yeah.
But you still have to look at things like jurisdiction with them. Just be careful. Don't buy something where all their assets are in Mexico right now. Have them go for diversification, or in the case of an explorer, 1 or 2 properties in a good jurisdiction.
Right.
And then you'll still be okay because all those good numbers will still be reported. Everybody's going to report good earnings in the next year.
Right. I think you did mention one recently. I don't know if you want to share this with our listeners, but of course, I guess I should ask you, people should just go to your Substack page and they can sign up for the free stuff, right? And, or they
Yeah,
can subscribe to your letter. What are you charging now, John, for your letter?
yeah. Well, most of what I publish is free,
Yeah,
and some stuff is behind a paywall, and it's the stuff with actionable investment advice, like the
right,
portfolio that I'm running there
right.
is behind the paywall. But that's maybe one post out of 4 or 5 or so, and everything else is free. So yeah.
Okay. And so there's a name that you just came up with, I think, on April 15th. That looks pretty interesting, the silver space. So the
Well,
people, yeah.
Jay, what do you think of that one?
What?
Is that one you cover?
I don't. I'm going to look into it though, having read your letter, and it's not one that I know too much about yet. But if you want to mention
Okay.
it or not,
Well, I'd like to leave that behind the paywall for a while
exactly.
because it's a really recent pick,
Uh-huh.
and that gives paying subscribers value when something
Sure.
like that stays
Absolutely.
back there for a while.
Absolutely. And it's a very modest price that you charge, I believe, John. So um, I think people would do well. At least go to John's site, go to his website page, and take advantage of the free stuff. And you'll get a teaser here and there to say, why don't you take a look at Company X, which I won't tell you about right now for sure. But I may pick it up for my own subscribers. We shall see. John, thank you so much. Anything else you'd like to add before we conclude our discussion today?
Oh no, Jay, we covered a lot of territory, but it's a fascinating world right now, huh?
It's
For
a
people like you and
fascinating
me
world.
who we've been obsessing about this stuff for
Oh,
decades, and
it's
it's finally
literally you and
starting to
I for
happen.
decades.
Yeah.
And John, you and I are not among those majority of people in the financial world who have never seen um, a time when there wasn't a put. Started with
Hmm.
Greenspan put, right?
Yep.
I mean, I remember the stock market crash of 97, that was, or 87. I'm losing track now. 1987 was the big one when Greenspan was the maestro, and we had the president's working group or whatever it's called, plunge protection team, and some people called it. Still in operation, I think, probably being used right now to try to keep the world from falling apart. But eventually, I think, you know, you can't fool Mother Nature forever, John, and the math doesn't work at some point. And I think not because I want to see it, because I think there could be a lot of pain and suffering, but I think we're as ready as we can be financially if you've stayed out of debt, if you own some hard assets, gold and silver, starting with those. And anyway, all right, John. Well, anything else?
No, that'll do it,
We've
Jay.
covered it.
Thanks.
We've
Yeah.
covered it. Thank you, and always enjoy your Substack. A lot of very interesting articles, of course, that we didn't touch on today. So, thank you very much.
Thanks, Jay. Take care.
All right, folks, that's it for this week. Next week, I'm not sure who my guest will be just yet, but keep an eye on your inbox and you'll be sure to know. Next Saturday, see you then.